Good morning, everyone. It's Terry Gardner from CJ Lawrence on Thursday, February 27th. And I want to follow up on yesterday's video where we touched on the coronavirus and the impact that it was having on global equity markets. Well, the equity markets globally, and particularly here in the U.S., traded off again this morning with the S&P 500 opening down about 3%. It's down about 1.5% to 2% now, so it's retraced some of those losses. But it's clear that the momentum is still negative and that further selling pressure could be ahead. Given that, we thought we'd want to add some context to this market, and we've got 3 points to our video today. The first being is that the bull market is still intact. The second being that while 2020 earnings expectations will likely be ratcheted down meaningfully in the coming weeks and months, 2021 estimates could be too low. And third, that historic valuation ranges point to higher stock prices from here. So first off, the bull market, we're down about 11% from our peak, but we haven't erased multi-year gains. We haven't erased one-year gains. In fact, we're back to about where we were in October. So while the decline feels bad and has been based on fear and uncertainty, in the context of the long bull market, the bull's still very much intact. Secondly, with regard to 2020 expectations, it's likely that they're going to be coming in the coming weeks and months. In fact, you're starting to see it happen. Microsoft announced last night that they were reducing their guidance for 2020 based on supply chain challenges in Asia. And we're likely to see more of that to come. And in fact, Goldman Sachs is out with a note this morning suggesting that if the coronavirus isn't held in check soon, that earnings growth for 2020 could all but be erased. And so we'd see earnings come in this year at levels that we saw last year. We have a view that if that were to be the case, we could be generating some pent-up demand in 2020. And that's why our view would be that 2021 expectations could be too low. What's interesting to us regarding this market is that this disruption and the slowdown in the economy is really precipitated by supply disruption and not demand destruction. And that's important, particularly with regard to valuations. Now, that won't be the case in every industry. So, for instance, in leisure, in hotels, airlines, gaming, they'll clearly see demand challenges by lack of consumer activity. But the consumer may offset those deferred purchases, deferred participation with expenses and expenditures in other areas like staying at home, streaming of content. And we can see that playing out a little bit today. If you look at Netflix, in this down market, Netflix is up about 2%. So the bet is that people will stay home, stream more content. They may order more groceries and goods to be delivered as opposed to going to stores and malls, benefiting companies like Amazon. And certainly companies like gaming and social media companies would benefit from a consumer that stays at home seeking entertainment in their living room as opposed to going out on leisure trips, visits, store visits, etc. So based on 2021 expectations, which we think will hold firm, and using historic valuation ranges that have held for the past 6 or 7 years, the market actually looks pretty attractively valued. Now, that's not to say that earnings expectations couldn't fall further and will be faced with additional uncertainties in the coming months, but just based on simple math, if you use the low end of the multiple range for the past couple of years of 16 times forward expectations with a high end of 18 times forward expectations, that would suggest market prices 3% higher from here on the low end and 16% higher on the high end. So I think that's important to keep in mind as we think about the market. Worst case scenarios, reduced expectations, even based on that, given where interest rates are, should the market trade at historic valuation ranges, we could still see higher stock prices from here. The net is stay the course. We're still constructive on the bull market and on the underpinnings for the market. There'll be a lot of uncertainty that we have to face. We've got to look across the valley and be positioned for growth on the other side. Should you have any questions, give us a ring here at CJ Lawrence. Again, it's Terry Gardner. Have a great day.